How the trade war is making retirement planning harder.
Marketplace Morning Report is supported by Progressive Insurance. Progressive is looking for individuals who want to join an inclusive and unique culture. More information, including application, at progressive.com/careers.
I'm David Brancaccio in Los Angeles. After the Trump administration confirmed yesterday China tariffs are up at 145%, China today put its tariffs on U.S. goods up to 125%, but said it would ignore any further escalation by the U.S. Meanwhile, one of the big banks, Morgan Stanley, reported strong profits for last quarter this morning, but raised a warning flag about loan losses ahead and turbulence in financial markets given tariffs. With worries of recession, the U.S. dollar hit a 3-year low today. A euro costs $1.14 now. Here's Marketplace's Nancy Marshall-Genzer.
Usually the dollar rises when there's global turmoil because investors see the greenback as a safe haven. That's not happening right now. Last week, Deutsche Bank warned there could be a crisis of confidence in the dollar as investors grapple with the uncertainty caused by the on-again, off-again U.S. tariffs and some economists' grim predictions of recession. A lower dollar means you'll pay more for imports because it takes more dollars to buy the foreign currency importers need to buy things from other countries. Importers usually pass that extra cost on to consumers. But a lower dollar makes U.S. exports cheaper. Foreigners are essentially getting them at a discount because they get more dollars for their currency, which they can then use to buy U.S. products. I'm Nancy Marshall-Genzer for Marketplace.
S&P and NASDAQ futures are up in the 6 to 0.7% range after a key reading on wholesale inflation came in tame this morning. That's for pre-tariffs March and mostly due to falling crude oil prices. The bond market is down, pushing the 10-year interest rate up to 4.46%. Now, stocks, the S&P is down 7.1% since just before President Trump's April 2nd tariff announcement and down 10.4% year to date. The NASDAQ is down 15% year to date. What are we supposed to do about it? Let's consult Barry Ritholtz, Chairman and Chief Investment Officer at Ritholtz Wealth Management in New York. Welcome.
Well, thank you for having me.
Let me guess. I bet this happens to you. It happens to me when people know what I do for a living. It probably goes something like, hey, Bear, should I buy the next dip in the market? What do you tell them?
So my answer is always, what are your financial goals? When are you planning on retiring? When do you need this money? If you're 10, 20 years away from retirement, sure, you should be making regular contributions. And every time the market is 15, 20, 25% down, you should throw a little more capital at it. But if you're retiring in the next 12, 18, 24 months, hey, maybe buying the dip isn't ideal for you because you're going to be drawing down. And you have to make sure your portfolio is robust enough to withstand that sort of volatility.
I mean, I feel especially bad for people who need their money right away. They turn 65 not in months, but 5 weeks from now, and they were all set to jump out of the rat race, and all this happened.
That is one of the biggest problems that we encounter. In fact, no less notable than Bill Sharpe, Nobel laureate, has said that challenge is one of the thorniest problems in all of finance.
Thorniest problems is knowing when to get out, or if you're getting close to really needing your money, what posture do you adopt?
Some people have described this as a sequence of returns problem. It's knowing that if you start retirement in a drawdown, it has a substantial impact on how much money you're capable of pulling out over your lifetime. In other words, you're much better off with a plus 10% and having a minus 10% somewhere 10 years down the road than starting out 10% in the hole. Anything you sell to draw down, and let's use 4% as kind of the industry standard, that's 4% that you're drawing down at a minus 10% that never has a chance to recover.
Could be parents who need to pay for some college education soon, or they want to liquidate to get a house, but it's something that you need to plan for.
That's right. If you have a young child who's not going to college for 10 or 15 years, it's a non-issue today because you're looking on the other side of this. On the other hand, if you have a 15-year-old who's going to start college in 2026, 2027, this is a really challenging set of circumstances.
Barry Ritholtz, co-founder, chairman, and chief investment manager at Ritholtz Wealth Management. He's also author of How Not to Invest. Barry, always good to catch up.
Thanks so much.
Marketplace Morning Report is supported by Schwab. Schwab offers investors choices like full-service wealth management, self-directed investing options, and trading on Think or Swim. More at schwab.com. And by Viking, exploring the world in comfort. With a fleet of small ships, Viking offers travel experiences for the thinking person. Discover more at Viking.com.
Can you mix Prada with Versace, or is that a fashion faux pas? Prada of Italy is buying Versace, also from Bella Italia. Capri Holdings, Versace's parent, is paying $1.4 billion. Now, as a guy who wears Patagonia and LL Bean, I hadn't realized that Versace and Prada customers are different. Marketplace's Stephanie Hughes has more.
Think of Prada's clothing as being more minimalist and Versace's as being more maximalist.
Very dynamic color, very unique look, a little bit of that Roman Caligula look.
Milton Pedraza leads the Luxury Institute, a consulting firm. He's done some work for Versace in the past. He says one challenge Versace faces is that its clothes aren't necessarily everyday staples. Versace's revenue dropped by 15% last quarter. And Pedraza says with this acquisition, Prada is getting a well-respected fixer-upper, and one that could put it on a new path, where we see
At least the beginnings of a luxury fashion conglomerate that is Italian-owned and Italian-driven.
But it'll need to find its customers all around the world, says Susan Scafidi, founder of the Fashion Law Institute at Fordham.
The Made in Italy label is key to luxury, but Made in Italy has to sell outside Italy. Italy is a substantial market, but it's not anywhere near as large as the U.S.
And Scafidi says aspirational consumers are a big part of that market. And if tariffs make those colorful Caligula-type pieces more expensive, then they might hold off. I'm Stephanie Hughes for Marketplace.
Our executive producer is Kelly Silvera. Our digital producers are Dylan Mietnin and Jared Dang. Our engineers are Brian Allison and John Brewington. In Los Angeles, I'm David Brancaccio. This is the Marketplace Morning Report. From APM, American Public Media.